All right, so today we're diving into the world of Berkshire Hathaway, and to do that, we're going to be looking at a couple of Warren Buffett's letters to shareholders, specifically the 2022 and 2023 editions. And these letters, well, they're not just like your typical dry financial reports. He talks about all sorts of things, like from the characteristics of Berkshire shareholders to his own reflections on investing. So we're going to kind of unpack some of his wisdom, try to figure out what his secret sauce is for long-term success, and we'll also take a look at the massive scale of Berkshire Hathaway's contributions to federal taxes.
Wow, sounds fascinating.
Yeah, that's pretty amazing stuff. So let's start with the 2022 letter. And right away, he kind of jumps into this discussion about performance and how Berkshire stacks up against the S&P 500. And he lays it all out year by year, going all the way back to 1965. And striking that from 1965 to 2022, Berkshire boasts a compounded annual gain of 19.8%, while the S&P sits at 9.9%. Now, at first glance, you might think, okay, big numbers, but
That's where Buffett's brilliance really comes through. He doesn't just focus on the numbers. He goes beyond that and emphasizes the human element, like right off the bat. He acknowledges the trust that Berkshire shareholders have placed in him and his partner, Charlie Munger. He actually describes these shareholders as dedicated savers. And what's interesting is that many of them end up donating most of their wealth to philanthropy.
so it's like he's portraying Berkshire Hathaway as more than just this company, almost like it's this community of like-minded individuals who share this long-term vision.
And a commitment to giving back.
Exactly. He even calls them once a saver, always a saver, folks, which kind of highlights the long-term mindset that's like woven into the very fabric of Berkshire Hathaway. And that long-term approach, it's really key to understanding how Buffett and Munger make their investment decisions. So they invest in two main ways. One is by wholly owning businesses, which give them control over things like capital allocation and choosing the CEOs. And then the other way is through passively owning publicly traded stocks.
So they're not just stock pickers, right? Yeah, he actually makes a distinction between being a stock picker versus a business picker. And that's a crucial difference. Buffett and Munger, they're not interested in chasing quick profits or trying to time the market. They look for companies that have strong, lasting economic foundations and leaders they can trust. And this applies to both the companies they fully own and the stocks they hold.
And he even admits, that he's made mistakes along the way, pointing out that while some of their businesses are truly exceptional, others are just okay, and then some are even struggling.
Right, and that's where his concept of creative destruction comes in, which he borrows from the economist Joseph Schumpeter. He recognizes that in capitalism, you're going to have winners and losers, and sometimes businesses simply fade away, especially when their products become obsolete.
It's kind of like survival of the fittest in the business world. But let's shift our focus to those winners for a moment. Buffett shares his kind of secret sauce for investment success. And honestly, it's less about some secret formula and more about sticking to a sound philosophy. Like he uses his investments in Coca-Cola and American Express as prime examples.
Oh, yeah, those are great examples. So back in 1994, Berkshire bought 400 million shares of Coca-Cola for $1.3 billion. And their dividend that year was $75 million. But fast forward to 2022, that dividend skyrocketed to $704 million.
That's incredible growth.
Yeah, and the story with American Express is really similar. They started buying in 1995, also for $1.3 billion, and those annual dividends jumped from $41 million to a whopping $302 million.
He really just highlights the power of patience and letting your investments compound over time.
Exactly. Buffett compares it to a garden, he says. The weeds wither away in significance as the flowers bloom, essentially. Those few exceptional investments, the flowers, are what truly drive those returns over the long haul.
Okay, so now Buffett shifts gears a little bit, and he starts talking about how earnings are often reported. And he's actually pretty critical of GAAP earnings, which is the standard accounting measure. He calls it 100% misleading when you just look at them on a quarterly or annual basis.
So why does he say that?
Well, he thinks that focusing solely on GAAP earnings, which includes things like unrealized capital gains or losses, it can give you a distorted picture of how a company's really performing. Because these gains and losses, they can swing wildly from day to day. So instead, he prefers to look at what Berkshire calls operating earnings, which essentially strip away those volatile fluctuations and show a more stable and, in his view, a more accurate reflection of the company's performance.
So he's looking for a more consistent picture.
Exactly. And to kind of illustrate just how wild these GAAP earning swings can be, he actually provides a table in his letter showing the ups and downs for each quarter of 2022. And he even calls it acrobatic behavior, which I don't know about you,
Yeah.
but I get a pretty vivid image in my head when I read that.
I know, it paints quite the picture.
Yeah, so it's pretty clear that Buffett believes in looking beyond the superficial headlines and really digging deeper to understand the true health of a business. And speaking of which, let's talk about the acquisition of Alleghany Corporation, which is a property casualty insurer. This purchase was a really strategic move for Berkshire because it helped to bolster one of their key strengths, which is their enormous float.
Okay, so for those who aren't familiar with insurance jargon, can you break down what float is and why it's so important to Berkshire?
Absolutely. So float is essentially the money that insurance companies hold from premiums before they have to pay out claims. So it's basically free money that they can invest while they're waiting. And the Alleghany acquisition, it boosted Berkshire's float from a staggering $147 billion to an even more impressive $164 billion in 2022.
Wow, so it's like having this giant pool of cash that they can put to work.
Exactly. It's a huge competitive advantage.
And I read that since acquiring their first property casualty insurer back in 1967, Berkshire's float has grown an astounding 8,000-fold through acquisitions, operations, and innovation.
It's pretty remarkable. Now, he also talks about share repurchases, which is another way that Berkshire creates value for its shareholders.
But it seems like he's very specific about when and how those repurchases should be done.
Yeah, he's very clear that repurchases are only beneficial when they're done at the right price. Because when they're done at the right price, they increase the ownership stake of existing shareholders, which is a good thing. He even uses this analogy of a local auto dealership to illustrate how repurchases, when done right, can benefit everyone involved.
So it's about being strategic and making sure that those repurchases are creating value, not destroying it.
Exactly. He actually cautions against doing repurchases at inflated prices. He calls those foolish purchases that only benefit the sellers and the investment bankers who brokered the deal.
It's a good reminder that even with something as seemingly straightforward as share repurchases, it's all about making smart, value-driven decisions.
Okay, so before we move on to the next section of his 2022 letter, let's just take a quick pause and kind of recap what we've learned so far. What are some of the key takeaways?
So far, we've seen that Buffett really emphasizes the importance of long-term investing, picking businesses over stocks, and understanding that those earnings reports don't always tell the whole story. He also highlighted the power of Berkshire's massive float and their prudent approach to share repurchases. And I think it's important to note, he wrapped up this section by really stressing the importance of transparency and trust, assuring shareholders that he and Charlie Munger are managing Berkshire's money with the same care that they give their own.
It's like this sense of responsibility and stewardship that really sets them apart.
Absolutely. So in the next part, we'll delve deeper into Buffett's reflections on his own capital allocation decisions, the incredible power of compounding, and some surprising insights into the federal taxes paid by Berkshire Hathaway. You won't want to miss it.
All right, so we're back and picking up where we left off, exploring Warren Buffett's 2022 letter to shareholders, now in this section. He gets remarkably candid about his 58 years leading Berkshire. He actually admits that most of his capital allocation decisions have been, well, in his words, no better than so-so.
Wow, that's pretty surprising to hear, especially from someone who's considered like an investing legend.
I know, right? He's not afraid to admit his mistakes. He even credits luck for saving him from some potentially disastrous decisions, specifically mentioning U.S. Air and Salomon, but then thereabout. He reveals something really fascinating. He says that Berkshire's remarkable success is largely due to about a dozen truly great decisions, roughly one every 5 years.
So it's like a handful of really key moves.
Exactly. And he also points to what he calls a sometimes forgotten advantage that favors long-term investors. So what is this advantage he's talking about?
Well, he brings us back to his investments in Coca-Cola and American Express. Remember how we talked about that impressive dividend growth? Well, that's only part of the story. The real magic is in how the stock prices themselves have appreciated over time. So by the end of 2022, Berkshire's Coke investment was valued at $25 billion, and Amex was at $22 billion.
So they've just grown exponentially in value.
Exactly. And here's the kicker. Each of those holdings, it makes up about 5% of Berkshire's net worth, which is actually similar to their weighting decades ago, meaning they've grown at the same rate as Berkshire Hathaway itself.
It's a perfect example of the power of compounding. You buy great companies, you hold them for the long term, and the returns can be extraordinary.
Exactly. And to really hammer home the point, Buffett contrasts these winners with a hypothetical loser. So imagine an investment that didn't grow at all and just retained its initial value of $1.3 billion. That investment, it would now represent a measly 0.3% of Berkshire's net worth.
So the impact of those winners, it really dwarfs everything else.
Yeah, it's not just about picking the right companies. It's also about having the conviction to stick with them for the long haul.
You have to play the long game.
Exactly. And as Buffett puts it, the lesson for investors. The weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders.
And then, of course, he throws in a little bit of his trademark humor, adding, and yes, it helps to start early and live into your 90s as well.
Classic Buffett.
Right.
Yeah.
Okay, so now he kind of shifts gears again and starts discussing Berkshire's unique position within the U.S. economy. And some of the numbers he shares are pretty eye-opening.
What does he say?
Well, he starts by saying that in 2021, only 128 out of 5,000 publicly traded companies in the U.S. earned $3 billion or more.
So a very exclusive club.
Yeah, the big leagues.
Yeah.
And here's the impressive part. By the end of 2022, Berkshire was the largest owner of 8 of those giants. We're talking companies like American Express, Bank of America, Chevron, Coca-Cola, HP Inc., Moody's, Occidental Petroleum, and Paramount Global.
Wow, that's a seriously diversified portfolio.
It's like they own a piece of everything.
Right, and it doesn't stop there. In addition to those 8, Berkshire wholly owns BNSF, their railroad business, and 92% of BH Energy, their energy company, and each of those would earn over $3 billion if they were publicly traded.
So they're massive.
Yeah, he even points out that if they were public, they would actually replace 2 existing companies in the S&P 500.
It's incredible to think about. Berkshire Hathaway is like a microcosm of the entire American economy.
It really is. And he goes on to highlight Berkshire's unmatched staying power. You know, they always maintain this large cash position, and they avoid those risky moves. That could leave them needing cash during times of financial turmoil.
So they're prepared for anything.
Exactly. He's basically saying they're built to last. And then he touches upon Berkshire's future a bit, stating that there will be no finish line for the company. He envisions Berkshire always holding substantial cash, U.S. Treasury bills, and that diverse range of businesses.
It's about building a fortress, not chasing quick profits.
Exactly.
Okay, so now, get ready for this, because things are about to get really interesting. Buffett delves into the topic of federal taxes, and his perspective is quite surprising.
I'm intrigued.
Yeah. You might be surprised to learn just how much Berkshire contributes in taxes over 1 decade. They paid $32 billion.
Wow, that's a staggering amount.
I know, right? And to put that in perspective, he says if there were just 1,000 taxpayers like Berkshire, no one else in the U.S. would have to pay a dime in federal taxes.
That's mind-boggling.
It really is.
And he even uses this brilliant analogy to help us grasp the sheer size of these numbers. So, imagine converting $1 million into $100 bills. That stack would reach your chest. But picture $1 billion, that stack, it would reach about 3/4 of a mile into the sky.
Okay, I'm starting to get a sense of scale here.
Right. And then finally, imagine piling up $32 billion, the total of Berkshire's federal income tax payments for that decade. That stack grows to over 21 miles high.
That's 3 times the cruising altitude of commercial airplanes.
Exactly.
It's a powerful visual. That really drives home the point.
It really does.
So it's not just about their incredible scale, it's also about their substantial contribution to the U.S. Treasury.
Absolutely. And he doesn't stop there. He actually expresses hope that Berkshire will pay even more in taxes in the coming decade, stating simply, we owe the country no less.
He's acknowledging that America's dynamism has played a huge role in Berkshire's success.
Right, and he has this unwavering faith in the country's future. He even says, I have been investing for 80 years, more than 1/3 of our country's lifetime. Despite our citizens' penchant almost enthusiasm for self-criticism and self-doubt, I have yet to see a time when it made sense to make a long-term bet against America.
It's a powerful statement.
Okay.
Okay, so now we needed to prepare ourselves for a bit of a shift in tone, because the next section of the letter is a deeply personal and moving tribute to Charlie Munger, Buffett's longtime partner, who sadly passed away in November 2023, just shy of his 100th birthday.
Yeah, it's a beautiful tribute.
It is. He recounts their initial meeting, their early partnership, and how Munger ultimately shaped Berkshire Hathaway into the powerhouse it is today. He calls Munger the architect of Berkshire and describes himself as the general contractor, which I think perfectly encapsulates their dynamic partnership.
It really does. And he even admits that Munger was right to point out a dumb decision he made early on. When he bought control of Berkshire, Munger actually advised him to focus on acquiring exceptional businesses at fair prices, encouraging him to kind of involve his investment philosophy beyond the teachings of his mentor, Ben Graham.
It's a testament to their relationship that Munger felt comfortable offering such candid advice, even though he wasn't directly invested in Berkshire at that time.
Yeah, and what's remarkable is that Buffett emphasizes how Munger never sought credit for his contributions, always letting Buffett take the spotlight. He describes Munger as both an older brother and a loving father, highlighting the profound impact he had on both his life and Berkshire Hathaway.
It's clear that Munger's passing was a significant loss for Buffett, both personally and professionally.
It was.
It really makes you think about the importance of finding the right partner, both in business and in life, someone who challenges you, supports you,
Yeah.
and helps you become the best version of yourself.
Yeah.
Okay, so now, just to lighten the mood a bit, Buffett shares this anecdote about the shameless commercial hustle he and Munger engaged in at Berkshire Hathaway's annual shareholder meeting in Omaha.
Okay, tell me more about this.
So, he talks about their See's Candies kiosk, which sold a staggering 11 tons of peanut brittle and chocolates during the 2022 meeting.
11 tons.
11 tons.
That's incredible.
I know. He even breaks down the numbers, saying they were ringing up about 10 sales per minute during peak hours.
Wow.
He points out that the products haven't changed much in 101 years, proving that what worked for See's in the days of Henry Ford's Model T works now.
So it's a testament to the enduring power of a strong brand and a quality product, even in a world that's constantly changing.
Exactly. And he wraps up his 2022 letter with a warm invitation to the 2023 shareholder meeting in Omaha, saying, "Charlie, I, and the entire Berkshire bunch look forward to seeing you in Omaha on May 5 to 6. We will have a good time, and so will you."
You can really feel his genuine enthusiasm for connecting with Berkshire Hathaway's shareholders.
It's that personal touch that makes Berkshire Hathaway so unique. All right, so before we move on to Buffett's 2023 letter, let's take a moment to kind of reflect on some of the key takeaways from his 2022 letter. What are your thoughts?
Well, I think we saw that Buffett is remarkably candid about his mistakes, and he attributes much of Berkshire's success to just a handful of exceptional decisions made over decades. He reinforces the importance of long-term investing, patience, and the power of compounding. And we also gain insight into his perspective on federal taxes and the importance of giving back to society. And of course, his tribute to Charlie Munger was both touching and incredibly insightful.
It's a reminder that even the greatest investors are human. They make mistakes, learn from them, adapt, and rely on strong partnerships to achieve extraordinary results. Now, in the next part of our deep dive, we'll explore Warren Buffett's 2023 letter to shareholders, which covers some fascinating topics, including his sister Bertie's remarkable investment journey and the intriguing Omaha effect, so stay tuned. Okay, so now we're diving into Warren Buffett's 2023 letter to shareholders. And right off the bat, he kind of picks up on that intriguing Omaha effect we talked about earlier. You know, why Omaha seems to produce so many successful investors.
Yeah, I'm really curious to hear his thoughts on that.
Me too. But before he gets into that, he shares this really heartfelt tribute to Charlie Munger, his partner for decades, who passed away just before his 100th birthday.
Yeah, it's a really beautiful reflection on their relationship. You know, he talks about how they first met, their early partnership, and how Munger really shaped Berkshire into what it is today. He even admits that Munger pointed out a dumb decision he made when he first bought control of Berkshire.
Oh, really? What was that?
Well, Munger advised him to shift his focus to acquiring wonderful businesses at fair prices. He was encouraging him to kind of evolve his investment philosophy, to go beyond what he learned from his mentor, Ben Graham.
It's amazing that Munger was so upfront with him, even back then.
I know, right? It really shows the level of trust they had. And what's even more remarkable is that Buffett emphasizes how Munger never wanted the credit for his contributions. He always let Buffett take the lead.
That says a lot about his character.
It really does. He describes Munger as a mix of an older brother and a loving father. It's clear he had a huge impact on both his life and Berkshire Hathaway.
Yeah, it's a really touching testament to their partnership. Okay, so now Buffett kind of turns his attention to the readers of his letter, and he paints this picture of the ideal Berkshire Hathaway shareholder.
I'm all ears. What does he say?
Well, he describes them as individuals who are in it for the long haul. You know, they're not expecting to get rich quick. They understand that real wealth is built over time.
They share that long-term vision.
Exactly. And to illustrate this point, he brings up his sister, Bertie. He calls her the perfect mental model for the type of investor Berkshire wants.
Interesting.
Yeah, he describes her as intelligent, thoughtful, someone who's always willing to challenge him, But they still maintain a strong relationship. And she and her 3 daughters have a big chunk of their savings invested in Berkshire. So she's personally invested in the company's success.
I love that he included that personal touch.
Me too. Okay, so now let's talk about the financial side of things. Buffett dives into this discussion about net earnings, as reported under GAAP accounting rules. And, he points out how volatile these figures can be, driven by those unrealized capital gains or losses that can swing billions of dollars in a day.
So he's saying that the bottom line number, the one everyone focuses on, isn't always the whole story.
Exactly. He thinks it can be misleading. Instead, he prefers to look at what Berkshire calls operating earnings, which excludes those volatile capital gains and losses.
So it gives you a more stable view.
Yeah, a more accurate reflection of how the underlying businesses are actually performing.
Makes sense.
Okay, so moving beyond the numbers a bit. Buffett reiterates his belief in the long-term power of capital gains. He says he's always had most of his net worth invested in U.S.-based equities. He even mentions his first stock purchase back in 1942, when the Dow was below 100.
Wow, talk about long-term.
I know, right? He's seen it all.
And yet he still has faith in American business.
It's pretty remarkable. Okay, so now he talks about Berkshire's overarching business strategy, emphasizing their focus on acquiring companies with solid fundamentals built to last.
It's about finding those enduring businesses.
Exactly, the ones that can weather the storms and keep generating value. But he acknowledges it's not easy to predict which ones will thrive.
Right, no one has a crystal ball.
Yeah, exactly. He prefers companies that can reinvest capital at high rates of return, emphasizing that even owning just one of those can create enormous wealth over time. But he also stresses the importance of finding trustworthy managers. And he admits that they've had their fair share of disappointments in that area. He even quotes Hugh McCulloch, the first comptroller of the United States, who said, "Never deal with a rascal under the expectation that you can prevent him from cheating you."
Wise words.
So true. Now, he also acknowledges that Berkshire's size is a bit of a challenge now when it comes to finding new acquisitions. There just aren't that many companies out there that are big enough to move the needle for them.
It's a good problem to have, I guess.
Right. But he doesn't shy away from the realities of the current investment landscape either. He points out that markets can seize up, even vanish completely, like they did in 1914 and 2001. He cautions investors who think that American markets have become inherently more stable, reminding them of the 2008 crisis.
It's a good reality check.
It is. But he also highlights how Berkshire is uniquely positioned to respond to those kinds of market dislocations. They've got tons of cash on hand and a proven track record. He even compares today's markets to casinos, saying, "The casino now resides in many homes and daily tempts the occupants."
He's warning against that get-rich-quick mentality.
Absolutely. He's not a fan of the feverish activity that's often promoted by Wall Street, pointing out that while they want their customers to make money, they're really driven by high trading volume.
Regardless of whether it's actually good for the investor.
Exactly. So he urges investors to be mindful of whose interests are truly being served.
It's important to think critically.
Absolutely. Now, here's where he lays out a core principle of Berkshire's philosophy. Never risk permanent loss of capital. He knows that their extreme fiscal conservatism might seem excessive, but their top priority is protecting their shareholders' capital, even during tough times.
It's like an insurance policy.
Yeah, he uses that analogy. And to illustrate this long-term approach, he brings us back to those investments in Coca-Cola and American Express. They haven't bought or sold a share of either company in over 20 years.
Wow. Buy and hold at its finest.
It's amazing. He also talks about Occidental Petroleum and 5 large Japanese trading companies. These are investments they plan to hold indefinitely.
It's clear he's looking for companies that align with his values. Long-term thinking, shareholder focus, responsible management.
Exactly. Now, of course, not everything is always smooth sailing. He talks about some of the challenges faced by BNSF, their railroad business, and Berkshire Hathaway Energy. BNSF has been dealing with rising labor costs, and it's tough to find qualified workers willing to do that kind of demanding work. And Berkshire Hathaway Energy is facing regulatory hurdles. In some states, they're even facing the possibility of zero profitability or even bankruptcy.
It's a reminder that even the best companies face headwinds.
Absolutely. But then he balances that out by talking about the incredible success of their insurance business. Record results in sales, float, and underwriting profits. He gives a lot of credit to Ajit Jain, who joined Berkshire back in 1986. He calls Berkshire's insurance managers the Cooperstown of PC insurance.
That's high praise.
It is. Okay, so to wrap things up, He brings us back to that Omaha effect. Why Omaha has produced so many great investors.
Yeah, what's in the water out there?
Right. He even jokes about that in the letter. He invites readers to come to the annual meeting in Omaha. Maybe they'll discover the secret.
I love that.
It's a fun way to end a letter that's filled with so much wisdom and valuable lessons.
It really is.
Well, I think that brings us to the end of our deep dive into Warren Buffett's world.
It's been a fascinating journey.
What are your final thoughts?
I think Buffett's approach to investing is both inspiring and refreshingly simple. He doesn't overcomplicate things. He finds great businesses, holds them for the long term, and lets compounding do its work. It's all about patience, discipline, and integrity.
He's a great reminder that building wealth is a marathon, not a sprint.
Absolutely.
And he also shows us that even the best investors are human, they make mistakes, they learn, and they keep growing. And he highlights the importance of partnerships, finding those people who share your values and make you better.
Couldn't agree more.
Well, thanks for joining us on this deep dive into Warren Buffett and Berkshire Hathaway. We encourage everyone to read his letters, and hey, maybe even head out to Omaha for that annual meeting.
It sounds like an experience.
Until next time, remember to invest wisely and keep learning.